silent collapse. Why global currencies are failing together. Have you noticed something strange lately? Your money doesn't stretch as far as it used to. Prices go up, groceries, gas, rent, but your salary stays the same. No matter where you live, it feels like your currency is quietly losing power. But here's the thing, this isn't just happening in your country. It's happening everywhere. From the United States to the Eurozone, from Japan to emerging economies across Africa and South America, currencies are falling together, in slow motion, almost silently. It's not a crash with headlines and sirens. It's more like a leak in the hull of a global financial ship, and no one seems to be plugging it. So what's going on? Why are the world's major fiat currencies, the very lifeblood of our global economy, declining in value all at once? And more importantly, what does it mean for you? In this video, we're going deep. Not into conspiracy theories or clickbait panic, but into the hard, uncomfortable truth backed by data, history, and global events. We'll explore how decades of easy money policies, unchecked money printing, and growing distrust in centralized systems have all converged into a global monetary crisis. We'll look at how inflation, once considered a local issue, has become a synchronized threat across continents. We'll unpack how countries are shifting away from the US dollar in quiet defiance, sparking what some are calling a currency war. And we'll examine how digital alternatives, from Bitcoin to central bank digital currencies, CBDCs, are emerging as both solutions and threats. This isn't just a financial story. This is a story about control, survival, and the future of value itself. If you want to understand what's really happening to your money and how to protect your future, you're in the right place. Welcome to Money Minded. Hit that like button, subscribe, and share this video with someone who needs to hear the truth. Let's begin. Chapter 1: The Era of Easy Money. To understand why currencies are collapsing together, we must first understand the era that brought us here, the era of easy money. It started with good intentions. When the 2008 financial crisis brought the world economy to its knees, central banks had to act fast. The Federal Reserve, the European Central Bank, the Bank of Japan, all deployed the same weapon, quantitative easing, or QE. That's a fancy term for printing money to buy government bonds and inject liquidity into the system. At first, it seemed to work. Markets recovered. Banks stabilized. Economies slowly got back on their feet. But something changed. What was supposed to be a short-term emergency tool became a long-term addiction. Over the next decade, global central banks printed trillions of dollars, euros, yen, and more, far beyond the needs of their economies. Interest rates were slashed to zero or even negative. Debt exploded. And no one seemed to mind, because inflation remained low, or so it seemed. Then came COVID-19. The pandemic triggered another wave of money printing, this time on an unimaginable scale. In just 2 years, the US printed more than 40% of all dollars in existence. Other countries followed suit. Governments handed out stimulus checks, subsidized industries, and flooded their economies with cheap money to avoid collapse. The result? A historic surge in the global money supply without a matching increase in productivity or real economic output. But money is not magic. You can't print prosperity. As more money chased the same amount of goods, inflation finally arrived, not gradually, but all at once. And not just in one country, but everywhere. From the US to Germany to Argentina, prices soared. The purchasing power of national currencies dropped. And for millions of people, especially the middle and working classes, it felt like their wealth was evaporating. So why didn't central banks see this coming? Or more accurately, why didn't they stop it? The truth is, they couldn't. They had built an entire system of markets, governments, and debt that only functions if money stays cheap and plentiful. Raising interest rates would slow inflation. Yes, but it could also crash housing markets, trigger bankruptcies, and make debt unpayable. In short, they were trapped. Welcome to the paradox of easy money. If central banks keep printing, inflation worsens and currencies weaken. If they tighten policy, economies slow, debt becomes unsustainable, and currencies still suffer. And this isn't just a US story. Japan has been in a 30-year cycle of zero interest and money printing. Europe has negative rates and massive QE. Even emerging markets try to mimic the West's playbook, with catastrophic consequences. The global financial system has become one giant feedback loop. Print, inflate, panic, tighten, recession, print again. This endless cycle has eroded trust in fiat currencies themselves. People are beginning to question a core assumption of modern finance: that money issued by governments will always retain its value. And here's the kicker: the more the system relies on central banks to fix things, the more it breaks. We've entered what some economists call the post-trust era of money. Currencies may still function, you can still buy groceries with dollars or euros, but the belief that they are stable, reliable stores of value is fading. And when that belief dies, collapse is no longer a matter of if, but when. This is the legacy of the easy money era: short-term relief, long-term decay. It's not just a policy failure. It's a systemic unraveling. But this is just the beginning. In the next chapter, we'll explore how inflation, once considered a domestic issue, is now striking nations simultaneously, with devastating consequences. Stay tuned. And if you're finding this valuable, give us a like and subscribe to Money Minded. Your support helps us keep delivering truth in a world full of noise. Chapter 2: Synchronized inflation. Inflation is nothing new. Economies have always had periods of rising prices. But historically, inflation was mostly a local phenomenon, triggered by domestic policies, crop failures, or political instability. What's happening now, however, is different. For the first time in modern history, inflation is hitting across the globe, all at once. In the United States, inflation surged to over 9% in 2022, the highest in 4 decades. Across the Eurozone, prices for energy and food skyrocketed. In the United Kingdom, people were forced to choose between heating and eating. Argentina, Turkey, and Lebanon faced double or triple-digit inflation, devastating middle-class savings. Even countries traditionally known for monetary discipline, like Germany or Switzerland, haven't been immune. So, what changed? Why is inflation no longer just a local problem, but a synchronized, global threat? The answer lies in 3 powerful forces: policy convergence, supply shocks, and deglobalization. 1. Policy convergence, printing in unison. As we saw in the last chapter, central banks around the world responded to crises, from the 2008 crash to COVID-19, with the same medicine: ultra-low interest rates and massive money printing. But when everyone prints together, something unexpected happens. Currencies might not fall against each other, but they all fall in real value, measured by what they can actually buy. It's like a race to the bottom, but with no clear winner. If the dollar weakens and the euro weakens, the exchange rate may not change dramatically, but prices rise on both sides of the Atlantic. This is what we're living through now. The illusion of currency stability on the surface, masking the deep erosion of purchasing power underneath. 2. Global supply shocks, one world. Shared pain. The pandemic exposed just how interconnected and fragile the global supply chain really is. Factories in Asia closed. Ports in the US clogged. Shipping costs soared. Microchip shortages delayed cars. Food exports from Ukraine and Russia, key global suppliers, were disrupted by war. Inflation didn't spread just because of money printing. It spread because scarcity became global. Whether you lived in Brazil, France, or South Korea, the same forces made goods more expensive, especially essentials like fuel, food, and housing materials. And because central banks can't print oil or wheat, their policies did little to stop the rise in prices. 3. De-globalization, the end of cheap everything. For decades, globalization kept inflation in check. Countries outsourced manufacturing to cheaper labor markets, imported inexpensive goods, and relied on just-in-time logistics. But now, that model is breaking down. Trade wars, geopolitical tensions, and pandemic-era nationalism have sparked a trend toward onshoring and protectionism. Countries are building local supply chains, hoarding strategic resources, and restricting exports. The age of cheap everything delivered fast is over. And that means higher baseline costs and higher inflation for everyone. The human cost of synchronized inflation is staggering. In countries with weaker currencies, imported goods became unaffordable overnight. Food riots have erupted in parts of Africa and Asia. In advanced economies, wage increases haven't kept pace with rising costs, hollowing out the middle class and fueling political discontent. What's worse? Traditional inflation-fighting tools aren't working. Raise interest rates? Sure. But that also means higher mortgage payments, slower growth, and rising unemployment. Cut government spending? Politically toxic. Strengthen the currency? How, when everyone else is doing the same? It's a global game of musical chairs, and the chairs are disappearing. What does this mean for you? You don't need to be an economist to feel it. You see it every time you check out at the grocery store or pay your electricity bill. Inflation is no longer just a number in a report, it's a lived reality. And if it's happening everywhere at once, then the problem isn't just your government or your central bank. The problem is the system itself. A system that relies on ever-expanding debt. A system that assumes infinite growth. A system where currencies are backed not by gold or productivity, but by promises and confidence. And confidence, once lost, is very hard to regain. As we move forward, the big question is, what replaces this system? Some nations are preparing to reduce their reliance on the US dollar. Others are experimenting with central bank digital currencies. Meanwhile, a growing number of individuals are turning to gold, crypto, and other hard assets to escape the inflation trap. We'll dive into all of that in the next chapter, where global power dynamics and monetary rebellion collide. Chapter 3: De-Dollarization and Currency Wars. If you're learning something new today, help us out. Like this video, subscribe to Money Minded, and share your thoughts in the comments. We read every one. Chapter 3: De-Dollarization and Currency Wars. For nearly a century, the United States dollar has ruled the world of money. It has been the global reserve currency, the backbone of international trade, the safe haven in times of crisis, the pricing unit for oil, gold, and nearly every major commodity. Why? Because the world trusted the US economy, its institutions, and the stability of its financial system. But today, that trust is eroding. Behind closed doors and in public summits, an increasing number of nations are asking a radical question. Why should we keep relying on the US dollar at all? This movement has a name: De-Dollarization. And it's not just a theory, it's happening right now. The rise of monetary independence. Countries like China, Russia, India, Brazil, Iran, and even Saudi Arabia are seeking alternatives to the dollar. They're signing bilateral trade agreements in their own currencies. They're stockpiling gold. They're creating payment systems to bypass SWIFT. And some are even considering a shared BRICS digital currency, backed by commodities, not promises. Why are they doing this? Because the dollar is no longer seen as a neutral tool. It's now a weapon. When the US froze Russia's dollar reserves and banned it from global payment systems in response to the war in Ukraine. It sent a clear message. If you go against US interests, your money can be turned off. That scared a lot of governments, even ones that weren't aligned with Russia. Suddenly, holding too many dollars didn't feel safe anymore. It felt risky. And so, the global financial order, built around the dollar, began to crack. Currency wars. More than exchange rates. But this isn't just about politics. It's about survival. As inflation surged globally, central banks scrambled to protect their currencies. The US Federal Reserve began aggressively hiking interest rates. That made the dollar stronger, and other currencies weaker by comparison. The result? A domino effect. Countries had to raise their own rates to avoid capital flight. Some spent billions of dollars defending their currencies. Others failed, leading to massive devaluations, higher import costs, and social unrest. Welcome to the new age of currency wars, not fought with tanks, but with interest rates, capital controls, and trade restrictions. And here's the twist. In a world this interconnected, when one currency rises, others must fall. But if everyone tries to protect their currency at the same time, global trade slows, growth collapses, and nobody wins. This is the silent war beneath the headlines, and it's reshaping the financial map of the 21st century. The new contenders. If the dollar's dominance is declining, what comes next? There are three main contenders, each with its own strengths and risks. 1. China's yuan. China is the world's second-largest economy and the biggest trading partner for dozens of countries. It's promoting the yuan for oil, metals, and Belt and Road projects. But capital controls and lack of transparency limit its global appeal, at least for now. 2. A BRICS digital currency. The idea of a shared currency among Brazil, Russia, India, China, and South Africa, backed by gold or a basket of commodities, is gaining traction. Such a currency could reduce dependence on the dollar in cross-border trade. But aligning diverse economies and political systems is no small task. 3. Gold. Bitcoin and decentralized assets. Outside the state system, individuals and institutions are turning to the neutral assets. Gold is making a comeback in central bank vaults. Bitcoin is increasingly seen as digital gold, a hedge against inflation and censorship. The rise of decentralized finance, DeFi, poses a direct challenge to traditional monetary control. A fragmented future. We're entering a multipolar monetary world. Instead of one dominant reserve currency, we may soon see multiple competing systems, each with its own rules, risks, and allies. That means more complexity, more volatility, but also more opportunity for innovation and independence. But make no mistake, this shift won't be smooth. As old powers resist and new systems rise, expect more financial turbulence, policy missteps, and geopolitical tension. And through it all, the average person, you and me, your neighbors, will be the ones caught in the crossfire. What can you do? You might be thinking, this is all happening at a global level. What can I possibly do about it? The answer is educate, diversify, and adapt. Educate yourself about how money really works. Diversify your assets, don't rely on a single currency or system. Adapt your mindset to a future that's less predictable, more digital, and increasingly decentralized. In the final chapter, we'll explore what that future might look like and how you can prepare. Conclusion. What comes next? A new financial order. If you've made it this far, thank you. Don't forget to like, subscribe, and share Money Minded. Your voice matters, and your awareness is your power. Conclusion. What comes next? A new financial order. We began this story with a quiet question. Why do currencies around the world seem to be failing at the same time? Now, we have a clearer view. the collapse we're witnessing isn't loud. It's not a dramatic crash like 1929 or 2008. It's silent, systemic, and deeply rooted in decades of decisions, from easy money to synchronized inflation, from weaponized finance to rising distrust in traditional monetary systems. But this isn't just a collapse. It's also a transition. We are living through the twilight of the old system, a dollar-dominated, debt-driven, inflation-prone model, and the chaotic birth of a new financial order. So, what might that future look like? From centralized to fragmented. The post-World War II era was defined by centralization. A few currencies ruled global trade. A handful of institutions set the rules. But the future will be more fragmented and perhaps more balanced. Regional blocs may adopt their own currencies or digital assets. Countries will diversify their reserves, less US dollars, more gold, yuan, crypto. Individuals will gain more control over their wealth through decentralized finance, stablecoins, and alternative assets. This won't be a clean transition. There will be instability. Some currencies may fail. Others may be restructured or digitized. But the direction is clear: more choice, more competition, more decentralization. The rise of financial literacy and sovereignty. In the past, most people never questioned money. You worked. You got paid. You saved. You spent. End of story. That era is over. As inflation eats away at savings and trust erodes, people are waking up. They're asking hard questions. They're learning about fiat, hard assets, central bank policies, and blockchain. This is the silver lining. The collapse of blind trust is making way for empowered decision-making. Ordinary people are reclaiming control not just over their money, but over their future. That's the mission of Money Minded, to help you navigate this storm with clarity, confidence, and calm. So, what should you do? There's no one-size-fits-all answer. But here are some principles to guide you in this new era. Stay informed. Follow global trends, not just local news. Diversify. Spread your financial exposure across currencies, asset classes, and geographies. Understand the system. Learn how central banks, inflation, debt, and digital money actually work. Be open to innovation. Whether it's crypto, gold, or new digital rails. Be curious, not fearful. Because in a time of transformation, the best asset you can hold is financial awareness. The global monetary system is shifting beneath our feet. Some will cling to the old. Others will seize the new. History will remember who was prepared and who was not. You've taken the first step by watching this video. Now keep going. This is Money Minded. If you found this valuable, give us a like, hit subscribe, and share it with someone who's ready to think bigger. A new financial order is coming. Don't get left behind.